Hello and welcome to Trade Maestro. Thank you for joining us. We know your time is valuable and we take that very seriously. Our presentation will begin shortly. While we wait, please take a moment to fully prepare for the presentation. First, make sure your audio is working. You should be hearing sound now. Also, please remove all distractions. The information we will be sharing is very important and we want to make sure you get as much out of it as possible. And finally, be sure to have a notepad and pen so that you can easily take notes and write down references that may be discussed. Thanks again for trusting Trade Maestro with your trading education. We will begin shortly. For thousands of years, if somebody wanted to learn a new skill, maybe learn to make boots or horse saddles, how did they learn that skill? They studied with a master. Trade Maestro builds on this tradition, the relationship between the mentor and the apprentice, but we do it all online. The term maestro means master or an artist of consummate skill. And that's what a trade maestro is. It's a person who has mastered the art of trading. I didn't want to create just another stock market trading company that sells classes. I've done that, and I don't think that's in the best interest of my apprentice. I want to walk him through the process of becoming a great trader, and you don't get there with information overload. You get there by doing it, by getting your hands dirty, by putting into practice. That's the only way to build a new skill.
I love how Jeremy teaches. I love the fact that he teaches things in such a real, practical way.
And he made me realize that I can do this.
I remember when I first started my trading journey, and let's just say I blew up at least 2 accounts.
I know this model of learning to trade works. I've had the opportunity to work with people from over 80 different countries.
And I was skeptical at first. I was kind of like, okay, are you sure about this?
I was always chasing stocks. I would always chase the next hot thing and never had an opportunity to get any profit from it.
I've helped people with trading accounts that are just a few dollars, and I've helped people with trading accounts that are over $1 million.
These courses give me a much wider perspective on what is really possible.
And what Jeremy does so well is that he breaks it down in a simple form so it's easy to understand.
They're just regular folks, and if I can teach them, I can teach you.
I didn't want to let someone else tell me what the play was and I just follow their lead. I wanted to learn it for myself.
My greatest joy is when somebody that I have taught over the last decade, they reach out and they say something like, you won't believe it, but I actually have people that are asking me to teach them how to trade. Is that okay? You think I can teach them?
Working with you taught me that, stocks go through ups and downs pretty regularly and pretty predictable.
The portion that my husband has now been able to take over and own has outperformed the market and is doing better than the rest of our retirement. It is totally life-changing.
Just to think that I touched people, I taught them to do something, I influenced a generation of traders, and now they're taking it forward and they're influencing the next.
At the end of the trade, I ended up making 140%.
It just gives me so much delight and joy knowing that I can still do something with my financial future.
This is not something that's only for other people. I can actually become financially independent.
Not only allow me to make better trades, more lucrative trades, but have more confidence while I trade.
This Trade Maestro membership is excellent because it's got something for everyone. If you're just starting out, or even if you've been trading for a while, you'll find something you like. You need to get enrolled right now. It's affordable. It's It's comprehensive. And it's risk-free because you can cancel anytime if you decide you don't like it. So if you want to learn to trade the stock market, or if you're looking to take your trading to the next level, you need to get enrolled as a Trade Maestro member right now. The following presentation is for educational purposes only. All examples and analysis are intended for these purposes and should not be considered as specific investment or trading advice. All examples are for the purposes of teaching and are not intended to suggest future results. The risk of loss in trading securities, options, futures, forex, and cryptocurrencies can be substantial. Individuals must consider all relevant risk factors, including their own personal financial situation, before trading. Options, futures, and forex are considered more sophisticated investment vehicles due to high leverage and are not suitable for all investors. Well, good morning. Good morning. It's great to be here with you. Welcome. For those of you on the West Coast, it's good morning. For those of you on the East Coast, good afternoon. And for those of us in the middle of America, it's the noon hour. I hope you're all doing fantastic today. I am Jeremy Whaley, founder of Trade Maestro, and it's wonderful to be with you for the live stream that almost never was. Well, we were going to go live no matter what, but what you don't know is we're going to actually have charts today, and we almost didn't because TradingView didn't want to send me my little code. I've been sitting here for an hour trying to get logged into TradingView, and if you've logged in, you know that it sends you a confirmation code to your text message, and it would send me the code after it had expired. And so I've been sitting here going back and forth, and literally like 3 minutes ago, I finally got the code. So I'm feeling very, very good that we can actually do everything today that I planned on doing. As into day number 18 of the Pick Winning Stocks Challenge, we're going to be talking about risk scaling. But before we do that, we want to get over here into TradingView, which again, fortunately, we actually have available today. I almost couldn't do this, but we are here, and we're going to do a little bit of looking at what's going on in the market. You can see, maybe you can see, over here on the right side, the Dow Jones is down 308 points after ending down. After ending to the downside, 600 plus points yesterday. Now, if you're just looking at that, you're just looking at, man, we're down another 300 points. You're feeling heavy. You might be feeling sad, maybe feeling a little scared, a little bearish. But actually, it's not all that bad. Take a look at the chart itself. And what you're going to notice is we actually have one of them green candles right there. You see that? One of them there green candles, as they like to say. Why? Because what we actually had is we had a closing price here that gapped down to here, and now we have traded up. That's why we have a green candle. Remember, candlesticks are constructed based on the closing price relative to the open price, not today's close versus yesterday's close. So right now, if the market closed right now, then relative to yesterday's close, yes, we would be down almost 300 points. But relative to what our trading session has been today, it's actually the opposite. In fact, we've had so many interesting candles this week and last week that I'm highly considering doing some training on candlesticks next week. I would love to know what you think. Put it there into the chat. Let me know if that sounds interesting to you. And there's so much information, so much data that is packed into these candlesticks, and most people do not know how to read them. They do not know how to interpret them. And the newer you are to trading, the less you understand them. That's just all there is to it. So I'm actually not that pessimistic about the picture that we see here being down 300 points. If you look at the S&P 500, S&P is actually up 35 points today. And the NASDAQ is up, relatively speaking, 28 points. But the irony here is the NASDAQ's got the red candle and the Dow has the green candle, even though it looks like it's down 300 points. If you remember yesterday, this is kind of what we anticipated. If we talked about this, if you were here yesterday when we talked about this, we said that the NASDAQ was really hitting some solid support levels right here. And I thought that the 16,000, 16,250 range is probably where it would hang out. That's what it's doing. It's hanging out right there at that really critical pivot level. Same thing for the S&P. And the S&P is hanging out at that really critical pivot level here. What's different about the Dow, as we discussed yesterday, is it was not really at the pivot. It was hanging out up here in no man's land. So that's what you see happening right now. what you see happening is it's trying to find its footing here somewhere. We've got several purple lines in here because there's been a lot of different pivot areas that have happened in this price range. But that's why you see the Dow really fighting, trying to find where it's going to land. And you see the S&P and the NASDAQ actually kind of getting more stable here. I do think, I said this yesterday and the day before, I said I feel like the rest of this week, being a shortened week, since we're not trading tomorrow, as it is Good Friday, I said I felt like the market would probably kind of be a little bit wonky this week, maybe not having a whole lot of movement. We didn't have a lot of movement on Monday and Tuesday. Yesterday, it was down a decent amount, but nothing overly scary. And then today, it looks like we're getting a little bit of a counter move on that, and it's kind of closing that gap a little bit. So, yeah, I think we're back to where we were, Monday or Tuesday, where it's like, hey, this week's probably not going to be that exciting. And I think that's kind of where we are. Volume did come in a little bit, and that's at least worth noting. It's at least interesting that volume has started to tick in a little bit yesterday, certainly later in the day. But all things considered, compared to where we were a week ago with all that volatility and all that chaos, we are not there. I'm going to take a look over here really fast at the VIX. This is your S&P volatility index, and you can see, as I've been saying all week, it's just continuing to go down. It is not going anywhere. Now, I know I have some lines on here, but these are not your typical support and resistance lines. We do not analyze VIX the same way that we do a regular chart. It's traded completely different if you even trade it at all, and I'm actually not even a big fan of trading VIX. It's really much better used as a measurement of what's going on than anything else. So that's where we are in the market. Your stochastics actually is still fairly bullish as far as the Dow is concerned, or actually as far as all of these are concerned, is still fairly bullish. So I'm not convinced that the bear trend is continuing yet. We'll have more data after today. We'll do a new update Sunday night, and then I'll be here Monday morning to give you guys an update as well. The other story that we were talking about yesterday, one of the stories was gold. Gold did have a pretty good week last week and this week. We initially got into this trade back here at 272. If you were with me in my profit picks on Sunday evenings, you were aware of that. We set that up around the first part of March. So here we are about 5-6 weeks into that trade. We hit our first target with ease. We hit our second target with ease. And yesterday we hit our third target on that. Just so you have an idea, that was a 3.71, $3.71 to 1 reward to risk ratio. We've been talking about reward to risk ratios all week as we've been dealing with risk management. This was one of those trades. People often say, hey, I don't know how to get a 2 to 1 reward to risk ratio. I don't know how to get a 3 to 1. Well, this is one of them right here. We just locked in $3.71 reward for every share that we traded as related to every dollar that we put to risk. So, if you traded 1,000 shares, then you made $3,071. If you traded 100 shares, you made $371. Just depends on how many shares you were trading of the position. But that's the gold trade that we were looking at yesterday. I wanted to update on that. Crypto pretty much continues to do the same thing. It does appear that Solana is trying so hard to get rolling here. I think Solana is putting in its base, but no, it has not confirmed the new bullish trend yet. So nothing to report there. All right, I think that's all I want to talk about in terms of the big picture overview. If you've got any questions on that, please feel free to type it into the chat. I would love to see your questions, love to try to answer them. And of course, this is probably a really good time. If you have not liked and subscribed to the channel yet, this is the time to do it. You need to like the channel. You need to subscribe to it. If you're over on Rumble, then you need to follow the channel. I'm going to look over here and see how many we got. We got a couple over here on Rumble. Rumble seems to get a lot more viewers about 3/4 of the way through. It's kind of weird. After we've been going live for a while, suddenly it's just like we get all these people over there on Rumble. Anyway, yeah, so if you haven't liked and subscribed, then do so. And with no further ado, if we don't have any more questions, then let's jump right into day number 18 of the Pick Winning Stocks Challenge. Day number 18. And today we're going to be talking about risk scaling. Risk scaling. This is part 3 of my 3 parts of risk management. So if you remember, Monday, we started talking about, let's see, was it Monday? I guess it would have been Tuesday. Monday, we did the introduction to risk management. Tuesday, we talked about risk reward. Yesterday, we talked about risk per trade. Now, each one of these pieces will help your trading become more and more secure. Hate to use that word because secure is a very nebulous word in the stock market, but it will help you preserve more of your capital. Each one of these things that you do. Risk reward will help you make sure that you're not going broke, because over time you start to see your equity curve going up. Risk per trade will make sure that you're not blowing your account out on one trade. And risk scaling, what this does is it will make sure that you stay in the game absolutely as long as possible. And that's what we're going to be looking at today. So let's do a quick review here. Risk and reward. You do not want to be risking more than you plan to make on a trade. Ideally, we said you want to make at least $2 for every $1 you put at risk. Ideally, you're going to earn at least $2 for every $1 you put at risk. It's better if you do $3 or more. Now, I realize that, not every trade is going to be a 3-to-1 reward to risk ratio. Certainly not on the first day you get into it, but there's plenty of them, and we set them up quite often. So that's the first principle, is risk reward. The second principle is your risk per trade. This is what we went through yesterday, and we said we want to limit the risk of an individual trade to 1 to 2% of your account with an absolute 5% max. And we defined the risk as the difference in your entry price and your exit price. The difference in your entry price and your exit. So if you enter at one price, whatever your stop is, that's going to be your exit if you were to lose money on it, that will be your risk. Okay, and you do not want more than that. That is the risk, and it needs to amount, whatever the risk is on that individual trade, whatever the size is of that trade, it does not need to account for more than 1 to 2% of your overall trading account. On a smaller account, 5% max. Okay. And I think we also talked about, we also talked about yesterday, how many times can you have a losing trade? If you're risking 5%, you can have 20 losing trades in a row. That's quite a few. That's a lot, right? But if you're risking 2%, you can have 50 losing trades in a row. If you're risking 1%, you can have 100 losing trades in a row. And I've never, ever had anybody that had 100 losing trades in a row. So I've had people that have had several, but 100? I mean, that's ridiculous. So if you're doing all the stuff right, you're not going to go broke. But here's the last piece, the last and final piece, and this is risk scaling. And this is the one that will really make sure you stay in the game. As long as you take a loss, or I should say as you take a loss, adjust the dollar amount that you're willing to lose down to match your new lower account balance. This is what I mean by scaling. As you take your losses, and they will happen, adjust your drawdown, the dollar amount that you're willing to lose on an individual trade, adjust it down to match your new lower account balance. By doing this, what you do is you extend your ability to stay in the game. You say, well, how long do I extend it? And the answer is a long time. It depends on how much money you got, but I'm going to run the stats with you here in just a moment. Let me give you an example on this. Let's say that you have an overall trading account of $100,000. Okay, great. You got a great, healthy $100,000 trading account. An individual trade, whenever you look at the risk, it should not amount to more than 1 or 2% of that $100,000 account. In this case, that would be $1,000. $1,000 would be 1%. $2,000 would be 2%. $5,000 would be 5%. So here's what happens. Inevitably, you're going to have a losing trade. You can't get away from it. It's the market. We have to plan for the losing trade. So with your $100,000 account, you set up your trade, you stop out, you lost $1,000. Now your account is no longer $100,000. Now your account is $99,000. After taking the trade that you lose on, you now have a $99,000 account. Now you can no longer risk $1,000. We're going to scale it down. Now you can only risk $990. You say, well, it's only $10. I realize it's only $10. But it's only $10 is the reason you've gone broke. The reason that people go broke is because they justify it's not enough money. They justify it's not a big enough dollar amount to worry about. And that's not the reality. I want to talk about this for a minute. If you go to trade for a professional firm, when you go trade for this firm, they're going to have specific risk tolerances that you can stay within, that you must stay within. Usually on an individual day, that's probably going to be maybe a max drawdown of 2.5% for that day. Possibly, if they're very liberal, it might be a 5% for an individual day. And if you hit that drawdown, guess what happens? You're frozen. Okay? Then they're going to have a max drawdown probably of 10%, at which point you get put in a penalty box and you don't get to play for a little while. So what you need to learn from the professionals is this. Whether you're managing a $10,000 account or whether you're managing $100,000 or $100 million, risk management is not a function of, oh, it's only $10, I'm willing to take the risk. It's a function of, can my account sustain it? Can my account sustain it? I often have said to people, you probably heard me say it last week, if you can't execute a simple strategy, you'll never execute a complicated one. In the same way, if you can't manage a small account, you'll never manage a large account. Because what happens is you start to get skewed by your own personal opinion. So for example, let's say that you're trading a $100,000 account and you say, well, it's only $10. I'll go ahead and take the risk. I can sustain it. Of course you can sustain it. Of course you can. But whenever you scale that, now you're managing $1 million account, it's a much larger number. But because you trained yourself to be sloppy with it, now when you have a larger account, you continue to be sloppy with it. Okay. Now the flip is true as well. Yes, you train yourself to be sloppy with it and you end up taking a risk you shouldn't take. That is true. But here's what's also true. If you do get a larger account, or when you do get a larger account that you're working with, and you start to have drawdown against it, maybe you should be comfortable with a $1,000 loss. In fact, if you were trading $1 million account, what's 1% of $1 million? 10,000, right? So you'd have a $10,000 drawdown. That's how much you can sustain for 1% of your account, $10,000 loss. But here's what will happen. If you've not conditioned yourself how to manage $1 million, what will happen is you'll have a $10,000 loss, and half of the way there, you're only down $5,000. Half the way, you bail. You're like, I can't believe it, I'm down $5,000. What do I do? Because you haven't conditioned yourself to understand scaling. So what this exercise does, what this discipline does, is it forces you with a smaller account to start scaling. And then when you have a larger account, you're already prepared for this. More importantly, why do we do it? Because you stay in the game. You stay in the game a lot longer. If you will do this technique, it will extend the number of losing trades that you could sustain. And I'm using numbers here that you're going to think are ridiculous, and that's the way you should think about it. You should think about them being ridiculous because what I don't want you doing is I don't want you afraid to trade. Most people are afraid to trade, therefore they sabotage their trades. But when you understand the numbers and you see that it's safe to trade, you see that it's safe if I stick within the confines of my risk management, it's safe. I'm not going to lose everything. I'm not going to go broke. I'm not going to, blow my account out on one trade. Once you understand that, you remove that emotion of fear that's so tied to the trades. So why do we do this scaling? Number one, it extends the number of losing trades you can sustain. Number two, it might actually be critical to extending your account life, especially if you have a smaller account. So let me go through some examples here. I've got a spreadsheet. We're going to walk through it. And if you remember yesterday, I said 1 or 2% is your ideal amount that you would put up for risk. You would not lose more than that. But on a smaller account, you might need to do 5%. Now, if you had 5% that you're putting at risk, how many trades can you have back-to-back that are losing trades before you go broke? The answer is 20. Okay, so it's not really that many. I mean, you shouldn't have 20 losing trades back-to-back. If you do, you definitely didn't learn what you were doing probably. I've never had 20 trades losing back-to-back ever. And I've blown some accounts out. Back in the day, I'd make money on 2 or 3 trades and lose everything on 1 or 2. But once you learn how to do it, and once you're actually managing it a little bit better, you should not have 20 losing trades back to back. That is an outlier to do that. Okay. So I'm starting with a number that you can sustain. You should be able to sustain. But watch what happens when we scale this. Okay. So you should be seeing my spreadsheet now. And nope, you're not seeing it. Let's try this again. You should be seeing my spreadsheet now. All right, there we go. On your first trade, let's say you had a $10,000 account. Okay, so this is a reasonable small account for you to be trading. You have a $10,000 account. Your risk percentage is 5%. That means on any one trade, you can lose $500. So you place a couple trades. You lose on the first one. Your new balance is $9,500. Now that you just lost $500, your new balance is $9,500. Now we're going to scale it down. 5% of that is $475. So the most you can afford to lose on this trade is $475. So we're scaling the risk. You see how that works? Instead of saying I'm going to risk 500, which is 5% of 10,000, we're now only going to risk 475, which is 5% of 9,500. Let's say you lost on that trade. Now your account value is down to $9,025. Well, now we're going to take 5% of that. That's $451. That's the most you can afford to lose on this trade. Why? Because we're scaling down. It's still 5% of your account, but we're scaling it down. We're not saying, okay, 20 trades back to back, lose 500 on each of them, and I'm out of the game. We're not going to say that. We're going to say, okay, if I lose, I'm scaling down the dollar amount that I'm willing to take as a hit. So 451, let's say we lose on that trade, your account balance is 8,574. Well, now we're going to take 5% of that. It leaves us with 429. I'm going to go a lot quicker here, so we're not going line by line, but you can see what happens after you've lost 8 or 9 trades at the bottom here. After 8 losing trades, you only have $6,634 left. 5% of that means after 9 losing trades, you can only risk $332 per share. Per trade. Still 5%, but we're no longer dealing with a $10,000 account because we've lost some. So now we're dealing with that $6,634 account. Make sense? Well, unfortunately, things happened the way they did. You lost again. 9 losing trades. For the 10th trade, now you only have $6,300. We take 5% of that. It's only $315, and we keep going. We keep going. After 18 trades, you only have $4,181 left. But let's keep going. And when we get to 20, notice what happens. You still have $3,773 remaining in your account. Now, if you had taken 5%, which was $500 of the $10,000, and you equally allocated 20 trades, and you said, I can lose 5% on each of these trades, and I got 20 trades to lose on. After 20 trades, you would be broke. You would have completely blown out your account. Here, by scaling, notice what happens. After 20 losing trades in a row, which, by the way, I can't imagine you would place that many losing trades. But if you did, after 20 losing trades in a row, you still have $3,773. If you haven't experienced enough pain yet and you haven't slowed down and said, I better learn what I'm doing, you still got $3,773 to work with. 5% of that means you can risk $189 on each of these trades moving forward. You continue to scale. Where do we land? After 27 trades, you still have $2,635. Keep going. After 36 trades, you still have $1,661. Keep scaling. After 45 losing trades in a row, you still have $1,047, which means you can risk 5%, which equals $52. And if you lose on that 45th trade in a row, you have exactly $995 left. You might be thinking, well, sheesh, I can keep scaling this. You can. But I just want to say with confidence, if you lose on 45 trades in a row and you only have $995 left, stop trading and come see me, because $995 is just enough to purchase an annual membership with Trade Maestro so we can fix what you're doing. Because if you lost on 45 trades in a row, you are not prepared to trade real money. You should not be trading real money. I have never worked with anybody who's lost 45 trades in a row. Never. It's an absurd number of losing trades. I've worked with people who've blown out their accounts on 2 or 3 trades. But I've never worked with somebody who on 45 trades in a row placed a bad trade. I mean, it's not going to happen. Statistically speaking, it's not going to happen. And that's why I say that this is a plan to keep you in the game. And if you look at all 3 of these levers of risk management that I've shared with you this week, you'll realize if I do all of them, I never need to go broke. And that's why I say no one should go broke trading the stock market. No one should go broke trading the crypto market. No one should go broke trading. You might have losses. That's normal. You might have more losses than you want. That's kind of normal. Blow the whole thing up? Shouldn't do it. If you blow the whole thing up, that means that you mismanaged something. And the 3 levers of risk management that we've talked about this week, number 1, risk reward. For every dollar you put at risk, the difference in your entry and your stop, for every dollar you put at risk, you want to have a $2 reward or better if and when you get to your profit or to your target on that trade. Okay, that's the first lever, risk reward. Second lever is the risk per trade. That's how much you're willing to lose. Ideally, it's 1% to 2%. If it's a small account, up to 5% on an individual trade. How much you're willing to lose. And then finally, the third lever that you just learned today, risk scaling. Now, here's what I can say with absolute confidence. With all the people that I've worked with, all the private coaching that we've worked with, it's not uncommon at all. I mean, it's very normal that I have somebody that comes in and says, hey, I win 60, 70% of my trades. You know, out of any 10 trades, 6 or 7 of them make money. However, my account value keeps going down. My equity, my overall account value. I don't know what I'm doing. I get this story all the time. And in 100% of those cases, it's one of 2 things that they're doing wrong. The first one, and the first place that we look, is this right here, the risk management. If you're setting up trades that have a 2-to-1 reward to risk ratio, you're managing your risk per trade, and you're doing your risk scaling, this will not happen. I guarantee it. If you're winning 60% of your trades, if you're winning 50% of your trades, actually statistically, if you're winning 34%, only 1 out of every 3 trades, just a little better than 1 out of 3. If you're basically trading at market odds and you do what I've just taught you here, you will at least break even. At least. So people who say they're winning 60, 70% of their trades, but their account value is going down, it's almost always found in this formula right here. The other place that it shows up is actually a mental issue, mindset issue. I don't want to say mental like they're not mental. They don't need a mental institute. Well, some of them might. But the mindset issue, what happens is you let your winning profits, you cut them short. You know, you look at your account and you say, oh, wow, I got a $100 profit. I'm going to take it. And then you look at your account one day and you're like, well, I haven't got to my stop, but I have a $300 loss and I don't want to take that. So you maybe remove your stop and you're basically self-sabotaging. Those are the 2 things that generally wipe out good trading, good traders as a whole. They're not doing good risk management, or in the middle of the trade, they're calling audibles, so to speak. They're not running your trading plan, and which really ends up being part of risk management as well. So if you do these things, you're going to stay in the game. I can't guarantee you're going to make a fortune. I can't guarantee you're going to be a millionaire in a month. You know, those are not things that I can guarantee. But I can tell you, if you follow the formula, and if you look at the big 3-week window, the Pick Winning Stocks Challenge, what we've been through, you know, week number 1, pick a winning trade. How do you pick a winning stock? You trade with momentum. You use your moving averages. You only trade with the momentum of the trend. That alone is going to beat market odds. Then step number 2 of the blueprint, we're going to apply an appropriate strategy. If the market's going up, we're going to do a bullish strategy. If the market's going down, we'll do a bearish strategy. Step number 3 of the blueprint is your risk management. And inside the risk management, reward to risk ratio, risk sizing, position sizing, risk per trade, and then risk scaling. And when you do all of those pieces of the formula, like I say, I can't guarantee that you're going to be Gordon Gekko. I mean, I have no idea how much you're going to make. If you're starting with $10,000, you're probably not going to be a billionaire next week. I'm pretty certain it's going to happen. That's just not the way the numbers work. However, if you follow the formula over time, you will see your equity curve going up because it's a formula. And with literally everybody that I work with, every one of my private clients, when we start working together and we start fine-tuning it, if they're not seeing their account equity go up, it always comes down to one of these things. And usually it's the risk management piece. Sometimes you just have bad market conditions. I mean, sometimes, last week we had a lot of trades stopped out last week. It's a very volatile week. It happens. But we plan for it. Remember, we plan for it. It's going to happen. And so, we if we prepare for the worst of times, we're only going to know good times. That's what we're doing here. All right. So let's give you some takeaways before we call it a day here. Risk to reward will help you stay focused on trades worth taking. Risk per trade will help you avoid too much exposure. And risk scaling, which is what we talked about today, will extend your plays. And if you do these things, there is no reason to ever go broke. Never go broke. It's not worth it. All right, folks, I hope you've gotten a lot out of this. If you have not liked and subscribed already, if you've not liked and subscribed to the channel, please do so. It is time. Those of you on Rumble, follow. Those of you on YouTube, like and subscribe. We will be back tomorrow, and tomorrow I'm going to talk about setting stop orders. Okay, so a major piece of what we talked about this week was the risk, the difference in entry and stop, but we haven't talked about stops. Where do we set the stops? How do we set the stops? We're going to talk about that tomorrow. So tomorrow, come back. It will be Good Friday. The market will be closed tomorrow, but we will still do our session, and I will get you into session number 19 of the Pick Winning Stocks Challenge. If you have any questions, please type them in. Put them in the comments. I'll come back later, and I'll look at the comments and answer anything. Or you can feel free to send me an email, jeremy@trademaestro.com. All right, I hope you guys have a wonderful day. I hope you have a wonderful afternoon. Blessings to all of you. Happy trading to all of you, and we'll talk to you soon. Have a great day.